Alrighty, so I'm filming three videos back to back here. I was totally wrong about the order. We're going over stock movement and patterns. Last video I said that we were doing stock selection management and sorry, stock selection, scanning and watch lists. That's next video. We need to talk about movement and patterns first so that you can sort of identify scanning and watch lists. You need context for that first. So we'll jump right into this. We're gonna take a little bit of a step back. I'm assuming you already know about candlesticks, but we're gonna go over it again just in case. So let's say that you had a 5 minute period where price is moving, and let's say that price moves something like this, right? Where it's real crude. It's just gonna move up and down and up and down and up and down. So what you would call this and how you would label this is that the beginning of that time period is gonna be the open. The lowest point within that time frame is the low, the highest point is the high, and then the end of that time period is the close. And so this is what's going to make up a single candlestick. So in this time period, it moved down, it moved up, and it moved lower again. But generally speaking, it opened, moved down a little bit, went way up, and then went down a little bit there at the end. And this is what that's going to look like represented as a candlestick. This is what almost every, like the bare basics of candlesticks is going to look like. Here's that labeled again. This is going to push up. So green candlesticks are going to open on the bar here, and then it'll push up. And then the same thing is true for red candlesticks. So for these, it'll open here, and then it'll push down below the open. And then this is going to be a very crude chart in terms of the most bearish and the most bullish. Bullish just being buying and bearish being selling. So this is sort of a very, very crude drawing of this, and this is not like down to a science. I don't think that you should put a ton of emphasis on individual candlesticks. I don't think that it's that important as a general rule of thumb, but this is sort of how that's going to go in terms of candlesticks. And then like the general fundamental idea of how stocks move is that any asset, right? So if you were just looking at SPY, if you were looking at the Nasdaq, if you were looking at the fucking QQQ, it doesn't matter. Everything is gonna move in these stair-step patterns. So we're gonna move up, and then we have to pull back and consolidate for a little bit, and then we move up again. We pull back, consolidate, and then the same thing, and it's gonna happen over and over and over and over again. So as swing traders, we are trying to sort of pull back. So these pullbacks are going to happen as retail shares book profit. So more so for individual stocks on assets and stuff like that, it is going to be driven by a lot of institutions. But on individual stocks, retail selling is sort of what's going to cause these pullbacks, and that's going to look like very, very smooth pullbacks and bounces on moving averages and sort of a thinning of price and volume. But then large distribution and institutional selling is going to look like that really, really choppy, like very, very increased volatility and large selling volume. So as swing traders, we're trying to position ourselves in a stock that is very strong, and then it's close to a breakout level where we've sort of seen like very classic retail selling and sort of a very clean consolidation period and a pullback into what could be the next leg up higher. So we're going to go over four main basing patterns. I don't think that you need to pay too much attention to like a basing pattern does not need to be textbook, right? Like what you see on the chart does not need to look exactly like this, but we're going to go over sort of what they look like as a whole so that you can understand exactly what we're looking for. So the first one is going to be a Darvas box. This is just where price is going to move up and then consolidate in a pretty clean and parallel range up in here with sort of equal lows and equal highs before moving higher. So there's always going to be two entry points here to any of these basing patterns, right? So you'll always have a bounce entry and then a breakout entry. So this is what the Darvas box is going to look like here. A wedge is going to be higher lows and lower highs, so where price is basically just pinching down into it. And so that's going to be your bounce entry, and then your breakout entry right here. A flag is the same thing, except a very flat top, and then you'll have higher lows, so price is sort of ramping up into a resistance point before it pinches out and breaks up to the upside. So bounce, breakout, and then a cup and handle is sort of a weird pattern. I could have drawn this a little bit better. Usually a cup and handle sort of undercuts a moving average, but the general idea here is that you have a really, really strong move up and sort of a big flush down to the downside, consolidation, move up, another consolidation as we hit resistance on this prior high, and then a move up to the upside. And I'll give you examples for what all of these look like. on the like an actual chart, but you'll have more than one entry for this. You can have a bounce entry here at the bottom of this range, and then you can have a breakout here, and then you can have another bounce and another breakout in that. So as far as what they look like on a chart, these are going to be sort of what Darvas boxes look like, where we have a lot of resistance, and you get these sort of candlestick wicks up in the top of this range here. They're about equal, and then same thing on the low side, and then yeah, same thing over here. This is what Darvas box is going to look like. And then you'll have what a wedge looks like, where you're getting these lower highs up in here, and then you can see we're building higher lows up in here, so that pinch, that contraction of price. And then for this one, this is going to be sort of that flag, so we're getting flat tops up in here, tops of candlesticks about at the same height, and then we're just building consistent lower highs up until this area where we have our eventual bounce in here, and then a breakout and spring to the upside. And then this is what sort of vaguely what a cup and handle is going to look like. So this is where you get these flat tops in the bottom range here, and you see this big selling or this big buying up, selling down. We've undercut some moving averages. We consolidate, move up, consolidate, move up again as we cross into this like new high territory. This is sort of what a cup and handle is going to look like. And then we also have a little bit of an additional bonus breakout, if you will. This is going to be another little wedge up in here. So lower highs on the top, higher lows on the bottom. Pinching a price, we break out to the upside very strong. That's really going to be it in terms of like stock movement and basing patterns. It's very, 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 very simple. We're going to keep it super, super clean on that, and because next video is going to be going over a lot of stock selection, and we're going to be going into some really minute details on that. This is sort of wrapping up the easy section of this series as a whole. This is sort of the next video, and the rest of the series as it goes forward is going to be where we get into the weeds of it and really the nitty gritty of everything. So I appreciate it, and I hope you guys enjoyed this video. Let me know if you have any questions. But yeah, we're going to get really, really into it next time. So I hope you guys enjoyed that.